Okay, good afternoon, everyone. Um, Today, George and I are going to present on the balance of payments. So between the two of us, we're going to be covering almost the entire balance of payments manual, BPM 6. So it's going to be an overview or a primer. So it's not going to be that detailed. But as you're watching this, I encourage you to maybe point out areas where we can delve deeper if it's going to be helpful for your own projects. But for now, we're just going to present on a broad overview of what the balance of payments are and what they contain. This is an outline of what I'm going to talk about. First, I'm going to give a overview of the BOP itself, its principles, what it's for, what it contains, and then I'm going to talk about the current account component of the balance of payments, which consists of four sub-accounts: the goods trade, services trade, primary income, secondary income. Meanwhile, after this, George will talk about the other accounts of the balance of payments, the capital account, the financial account, and a complementary set of statistics called the international investment position, which is intimately related to the financial account. All right, so this overview will discuss some key concepts about the balance of payments. The BOP records changes of ownership of resources between residents and non-residents. So this really is the key criteria for whether a transaction gets included into the BOP, whether or not it's a transaction between residents and non-residents. The key reference we're going to be using is the IMF's Balance of Payments and International Investment Position Manual, 6th edition, otherwise known as the BPM 6, which was published in 2009 following the 2008 version of the System of National Accounts. The 7th edition of the BPM 7, is scheduled to be published in March 2025, along with an SNA update. So right now it's at phase one, which is the research phase, and then afterwards they're going to be drafting it. So all of this will be based on the BPM 6. So like I said, residence is the main principle determining whether a transaction is included in the BOP. So how do we define residence? The economic territory where an institutional unit has its predominant center of economic interest is where it is said to have a specific location must exist within the territory. So for individuals and their associated unincorporated enterprises, it's usually the location of the household itself, while for corporations, it would be the location where they are registered. Note that a household can only be in one, can only have one residence. So every single member of that household must have the same residence. If there is a member of a household that is working abroad or living abroad, that member will automatically qualify as a different household, and it is already a non-resident of that territory. Corporations may have what are called branches if they have substantial activity in a territory that they are not a resident in. Branches are treated as residents. So when corporations interact with their branches, those will be counted in the BOP. Whereas if the branch interacts with the other units around it in that territory, it will not be in the BOP. Now, there's also this concept called a notional resident unit. Land and natural resources, as well as all the buildings, improvement structures that are on that land, must always be treated as an asset of the territory it is in. So if a country has its natural resources, it must show up in its balance sheets. However, what if a non-resident owns that land? This clearly cannot be. So statistically, we invent the concept of a notional resident unit that we say owns that land while the non-resident owns the notional resident unit. So if there is any sort of rental income and so forth, it will accrue to the notional resident unit, but it will then be income payable to the non-resident who owns it. So in that way, we maintain the convention that all natural resources are owned by the economic territory. Okay, moving on. The balance of payments in a simplified version looks like this. So we have here the current account and the capital account. These two handle transactions in goods and services, factor services, non-market transfers, and capital. On the other side is the financial account, which handles transactions in financial assets. And as the name suggests, these two must balance. That is, the surplus in credits over debits for the current and the capital account must equal the net acquisition of financial assets in the financial account. So if you subtract the two, you should get zero. If you don't get zero, then that would count as net errors and omissions, statistical discrepancy, in other words. Okay, within the current account, some balances are better known by other names. For example, the goods and services account, the balance there is normally referred to as the trade balance, whereas the balance in the primary income account is also called the net factor income from abroad. This is where we include FDI. And finally, for the secondary income account, we have what we call the balance net unilateral transfers, and it includes worker remittances and foreign aid. Okay, to put everything into perspective, let's review the national income identity and see where the balance of payments come in, or more specifically, the current account. So this is a familiar equation. These are the consumption and investment and government spending, which together comprise the gross national expenditure, or GNE. If you add to this the trade balance, you will get GDP, gross domestic product. Then if you add to it the net factor income from abroad, you will get gross national income. And finally, if you add net unilateral transfers, you will get gross disposable national income, or GDNI. This component is where the current account comes in. So all of these may be found in the current account. We can simplify this equation by replacing it with CA. So we get the very straightforward identity that the gross disposable national income is equal to gross national expenditure plus the current account balance. We can also rearrange this equation by transferring these three to the other side by subtracting it to get national saving. Okay. Sorry, just these two, consumption and government, so that we have savings on one side and investment plus the current account balance on the other. So this gives you the current account tells you how savings and investments are to be reconciled. So if you have a current account surplus, that means you are saving more than you are investing, and vice versa. So some countries are known to have a very large current account deficit, for example, the United States, which means that it is a net dissaver. Whereas a country like Japan, China, the East Asians, they have high savings and also high current account surpluses. All transactions in the BOP are counted in what's called double entry accounting. This is different from the SNA, which has quadruple entry accounting, because for the BOP, you really only are interested in residents. So here's some examples to make it concrete. Let's say an American tourist buys carpet in India for $500 using a credit card. The transactions in the BOP will first fall in the current, because that's an import of goods. And the corresponding entry in the financial account would be an export of home assets, because now the Indian enterprise will have a claim on American assets. Another example, let's say an American invests money in a Singaporean firm's stock. So here, all our transactions will be in the financial account, because this is just a transaction in financial assets. Another example, let's say an American donates $1,000 to a charity, which then gives relief goods to victims of natural disasters. This shows up in the current account only. first as an export of goods, and then as a transfer, a unilateral transfer, which shows up in the secondary income account. And then finally, let's say the US forgives debt owed by a developing nation. This one will be a capital transfer with a corresponding entry in the financial account. All right, now I'm going to talk about the details of each of the components of the current account, beginning with the goods portion. Under goods in current accounts, there are three general headings. We have general merchandise, goods under merchanting, and non-monetary gold. So general merchandise is the bulk of this subcomponent. To fix ideas, consider this diagram. I have on the top two panels the home territory, and then on the left and right, I have activities by residents and non-residents. So if I have a transaction like this, the green dot represents a resident and the red dot represents a non-resident. As you can see, the resident is in the home territory while the non-resident is in the foreign territory, and they are buying and selling with each other. Okay, compare that with a transaction like this, where the resident is in the foreign territory and it is buying and selling with a non-resident. And then finally, compare that with a third scenario where two non-residents are transacting with one another, but one non-resident is residing in the home country. So the very first scenario is what we call general merchandise. So this is a very straightforward exports, imports between residents and non-residents. It's very clear. But for this second scenario, this is where we have a bit of ambiguity. So for merchandise trade, this will not be counted as an international transaction because you are not actually crossing economic territories. But for the balance of payments, recall that the main principle is between whether or not it's between residents and non-residents. So in this case, it will be counted under the balance of payments, under the heading of merchanting. I'm going to give an example later to make this clearer. Finally, for the last scenario, this would not be in the BOP. So even if you have non-res or you have goods passing your territory, this will not be counted as an international transaction because it's between non-residents. So a good example of this would be embassies. If the U.S. embassy sends goods to, or rather the U.S. government sends goods to its embassy elsewhere, that's not going to be counted as an import because it's between a U.S. resident and a U.S. resident. Okay, let's talk about general merchandise. The primary source for this is the International Merchandise Trade Statistics, or the IMTS, which is built from customs data, ITRS, administrative data, and surveys. Like I said, this one is based on whether or not goods cross territories. So adjustments may be necessary to correct it for scope, timing, and valuation in order to make it consistent with the principles of the BOP. Here, this is what I mentioned. The key difference between them is that of territory versus residence, where residence is the key criterion for the BOP. Here are some areas where some adjustments may be necessary. The time of recording, for example. If the transaction occurs after after the good passes the economic border of the territory, then some adjustments may be necessary. For example, maybe a good is sent over abroad but has not actually been sold yet. It's just there for storage. Under the IMTS, this will count as an export, but since there has been no change of ownership yet, it will not yet be counted under the BOP, which means that if you send it back home without ever selling it, the BOP will be none the wiser. It will never count that transaction. Another difference would be in valuation, because in the BOP, everything has to be valued by the free on board or FOB principle. However, for the IMTS, While it uses the FOB principle for exports, it uses the cost insurance rate or CIF valuation principle for imports. So that has to be corrected in the BOP. The difference between the FOB and the CIF valuation is reallocated into BOP into freight services, insurance services, and if you get insurance claims, also in the secondary income account. So here's an example of this principle. Let's say we have two countries, this green country and this pink country, and you have a factory that produces goods that is then sent to the border for export. And then it is from that border, it is sent to the customs frontier of the red country or the pink country. It pays duties and then it gets transported to the final customer. The FOB valuation principle would value this good as 1 plus 2. So it's the cost of production plus the freight cost or the transport cost that brought it to the customs frontier. Meanwhile, if you were to value it by the CIF principle, then you would include the cost of transportation between customs frontier A and customs frontier B. So what we need to do is correct the CIF to the FOB in order for it to be in the BOP. Another concept is re-exports. These are when goods are imported and then exported again without substantially changing them. So in this case, the goods pass through the resident's territory, because if it does not, then we would count it under merchanting, which I'm going to talk about later. So these are just, in effect, these are just regular imports and exports, but given their rather special nature, it might be preferable to state them separately, especially since they have less connection to the economy as a whole. You know, if you just import and then immediately re-export, it doesn't really interact with your domestic economy. Here are some other concerns. Generic software is recorded under general merchandise unless the software is customized, in which case that extra value will be in services. Goods acquired by financial leases are included. So even if the legal ownership is still with the original owner, we have to make a distinction between that and economic ownership. So once economic ownership has changed hands, then it will be in the BOP. Gifts, humanitarian aid, and other goods received without payment are included, while illegal and smuggled goods are included. Okay, here's merchanting. These are goods that are traded by residents but do not enter the territory. There must be no physical change to the good itself. So here's a concrete example. Let's say an Indian enterprise purchases rare books in Europe for sale globally. So let's say it buys a rare book from Germany and then it sells it to an Italian. The book itself never passes through India, but the enterprise is Indian. So this will be recorded in India's BOP as goods acquired under merchanting. By convention, it will be recorded as a negative credit or negative export to Germany, and then it will be sold. So that this time it's a credit. And then the net here, the net will be under this net exports of goods under merchanting. Arithmetic. Right. If the good is changed, then it will fall under general merchandise. So an example would be, let's say a Japanese enterprise purchases oil from Indonesia, and then it gets an Indonesian firm to process it for a fee, and then it sells it to Vietnam. So in Japan's BOP, notice that it will not go through merchanting anymore. It will instead be general merchandise, so it's just a regular export-import. There is an added service payment here, which I'm going to be talking about in the next section, which is a purchase of services from abroad. Okay, and finally, non-monetary gold is the last component of the goods account. Monetary gold is used as a reserve asset by authorities. On the other hand, non-monetary gold is, well, not. This includes bullion, gold powder, and unwrought gold. Jewelry and things like that are not considered non-monetary gold, even if they contain gold. They will remain under general merchandise. So the reason why this is reported separately is because gold has, a special role in financial markets. So it's a good idea to keep track of transactions involving gold, even if it is not considered monetary. Okay, now let me just run through a list of things that are not in the BOP, but which might sound like they should be in BOP. Transit trade. So if goods pass through a territory with no change in ownership, then it will not be counted in the BOP. So the example earlier, what if you just bring in a good for storage and not sell it? This will not be in the BOP. Migrant personal items. So if you migrate abroad, the stuff you bring, that's not going to be imports. Goods for embassies, because like I said, these are transactions between two residents of the same territory. Temporary exports, imports. So if you send a good abroad for repair or storage, or you lease a goods, or you maybe send some artworks for exhibition, these will not be counted under the BOP. If you send the good for assembly and repackaging, and the ownership of them do not change, then they will not be under imports or exports. Instead, if they incur processing charges, they will be counted under services trade. So they won't be in the goods trade, they'll be in the services trade. Goods with no value will not be counted in the BOPs. So if you send waste for disposal or storage, this is not going to be an import or export. However, if there's an associated service charge, then it will be counted under services trade. If you return a good, let's say defective goods, the change in ownership is annulled, so it will not be in the BOP was initially. Now, even if all these things are not in the BOP, it may still be a good idea to keep track of some of them. For example, if you send a good abroad, maybe it might be sold in the future, so it might be a good idea to keep track of them anyway. Moreover, they may give rise to service charges. So again, it might be a good idea to keep track of them. In summary, the goods account of the current account looks something like this. You have general merchandise, and then you state separately re-exports, and then you have the net exports of goods under merchanting. Notice that they do not have debit entries because all of them are just in credit. And then you have non-monetary gold. Okay, moving on to the services component. The services trade are generally classified by type of service rather than provider. So it doesn't matter it doesn't matter who the person is conducting the transaction. It's about what type of service they are providing. So for example, a call center that sells products will be counted under trade-related services, but the same call center providing computer support will be counted under computing services. There are exceptions to this rule, namely in the travel, construction, and government services uh, categories. I'm going to be talking about travel and construction later, but for government services, these are your transactions between embassies, military bases, things like that. So in this case, the identity of the transactor is actually the key here rather than the type of service rendered. But in general, we will follow the principle that it's the type of service rather than the provider. Note that the purchase of services is different from compensation. So if there is an employer-employee relationship, this will not be counted under purchase of services. Rather, it will be in the primary income account under compensation of employees. Here's some additional information. You may find it in the Manual on Statistics in International Trade and Services, or EXITS. Here are the main classifications. Of course, it's going to vary country by country, but these are what was listed in the BPM6. For today, I will just talk about these four in detail. because the rest either require a more involved discussion or they are at least consistent with our practices in the SNA in general. So in the interest of time, I'll just do these four for now. Okay, manufacturing services on physical inputs owned by others refer to um, when you alter good without you actually owning the good. So here's a concrete example. This is what the example we looked at earlier. Let's say a Japanese purchases oil from Indonesia. Okay, so it bought the oil, now it owns the oil. And then it hires an Indonesian firm to process it. So that Indonesian firm never owns that oil, but it is hired to process it, in which case that services transaction is recorded under this category, manufacturing services on physical inputs owned by others. In Japan's BOP, it will look like this. So this under this category, it will have a debit of $300. Here's some other examples. Assembly of electronics and clothes, packing, labeling. All of these are examples of this category of services. However, if you have a pack related to transport, it will be included in transport services. And if you assemble prefabricated construction materials, it will be counted in construction. Okay, for transport services, these pertain to carriage of goods and people from one place to another, plus any auxiliary services. It can be classified by type or cargo. Type, it can be by sea, by air, by land. Others include rail, and so forth. Cargo refers to what they are carrying. It can be people, so that would be passengers, or it can be goods, that'll be freight. Passenger transport includes fees paid by carriers to travel agencies, but it excludes fees related to, unrelated to international transports. So, for example, if you're a tourist and then you if you hire a cab within the country itself, that will not be counted under transport services. Instead, it will be counted under travel services. For freight transport, these are the transport of goods. And because we use FOB valuation, we have to sort of make sure that we are counting freight where it needs to be counted. So let me make that more concrete. Let's go back to the example earlier. So we have FOB valuation here, which means that everything, all the costs within the green territory is what we will use to value the good being exported. Our assumption is that the exporter will pay this freight cost, while the importer will pay this freight cost. However, necessarily the case in the day-to-day transactions. Right. So if either exporter or importer deviate from this arrangement, freight services have to be what's called rerouted for the BOP. So for example, let's say that this is still paid by the importer, but let's say that according to their contract, the importer is responsible for actually transporting the good from the factory to the customs frontier. So this $200 is actually paid by the importer, which means that the BOP has to correct for this. This will be transferred to the freight services category provided by the importer to the exporter. So our assumption is always the exporter is the one who brings it to the customs frontier. And any deviation from that has to be adjusted, or the term is rerouted. All right, moving on to the next category, travel. Goods and services acquired from the economy by non-residents during visits to that economy are counted under travel expenses. Excuse me. This is transactor-based rather than product-based. So the bucks, the general rule. And it does not cover, or it does not have any limit to length of stay, as long as there is, of course, no change in residence. It can be classified by business or personal travel. Okay. Um, this travel category may be confused with the tourism satellite accounts. So there are some things that this category includes, but the tourism accounts exclude. So both of them includes tourists, of course, but this the BOP also includes students, medical workers, or sorry, medical tourists, and short-term workers. So even if these stay in the territory for more than a year, as long as they are non-residents, they will be counted in the BOP. On the other hand, travel expenses exclude these categories. So diplomats and military, again, since these are non-residents interacting with the, their fellow residents, they are not going to be counted onto travel receipts. Although if they interact, say the U.S. Embassy in Japan interacts with Japanese enterprises around it, that will be counted under government goods and services. Um, Goods for resale and purchases exceeding a customs threshold, that will be counted under general merchandise. So let's say you go to, let's say Thailand, and then you buy textiles for resale back home. That will not count under travel receipts. Rather, it's going to be counted as import. Um, and finally, international travel. It will be counted under transport services. So if you are in the Bahamas and you book a flight back home, that cost is not going to be counted under travel receipts. It's going to be counted under transport services. Okay, construction. Um, for construction services, these are typically short term since major projects are more associated with branches. And like we said, a branch, even if it is affiliated with a non-resident corporation, if we distinguish it as a branch, then it is treated as a resident unit, in which case it will drop out of the BOP. So when we say construction services, normally these are short-term projects undertaken by a resident and a non-resident. Okay, we can classify construction into two categories. You have construction abroad and construction in the compiling economy. So if we have Philippines, for example, or let's say a Philippine firm is contracted to build something abroad, then it will fall under this category. Whereas if a non-resident firm builds something in the Philippines, it will count under construction in the compiling economy. Here are some examples for what the credit and debit entries are going to be. Construction abroad will be work for non-residents by us, the Philippine construction company, while the debit would be goods and services acquired over there abroad. And then the flip side for the construction and the compiling economy. In summary, these are the entries for the services portion of the current account. Like I said, all these categories will depend on the country itself. If the country has very minimal, let's say, construction services, import and export, then it need not include this here. All right, moving on. The primary income account of the current account, the balance of payments. In the SNA, the primary income portion can be found in two accounts. Number one, the generation of a primary income account and the allocation of primary income account. Since in the balance of payments, we don't talk about production, there is really only one account where the primary income transactions fall under. This is the allocation. Primary income represents two things. Either it is your return for contributing to the production process, or it is your return for providing financial assets or natural resources. So here are the particulars of that. For providing or for contributing to the production process, you can either be compensated by wage or well, rather you have to pay taxes on it, on production. Whereas if you contribute by providing assets, then you can either generate property income in the form of rent, or you can generate investment income in the form of either dividends, reinvested earnings, or interest. So this is the structure of the primary income account. Notice that we have categorized it using what are called the functional categories, which I believe George will talk about in greater depth in her discussion on the financial account. On the other hand, we have other primary income where we put rent, taxes, and subsidies. Note that taxes here are only for taxes on production. Later on, we're going to talk about taxes on income and wealth and so forth, which are part of the secondary income account. Compensation of employees. This only arises when there's an employer-employee relationship, like I mentioned earlier. Contrast this with a service contract relationship, which would be recorded in services trade. The key criterion is who exercises control over the work done. So if you hire, let's say, an architect to design you a building, if the architect has control over how the work will be done, then that's a service contract relationship. But if you hire an architectural firm and then they have employees under them, those employees don't really have control over the project, so they will just receive a wage, in which case it's under compensation of employees. This includes cross-border employees like seasonal workers and domestic helpers. However, it excludes workers in embassies and military personnel, because again, these are people within the same residency. Compensation can come either in cash, in kind, or in social contributions by the employer. Cash wages are recorded before deducting taxes because the tax itself may be recorded elsewhere. You also record it before deducting contributions. This excludes relocation costs. So if you have a foreign worker you hire to work in your country and you pay them some relocation costs, that will not be counted under compensation. That will be counted under acquisition of goods and services. Wages in kind, valued at market prices. Employees can also be paid in stock options. So this is a form of compensation in kind. This has to be valued at the fair value of the underlying equity, and any changes to that value will be counted under holding gains and losses, which is in another account that George will talk about. All right, investment income. This can come in the form of dividends, which are earnings distributed to owners of equity. It excludes exceptional payments, which will count as withdrawals of equity and recorded in the financial account. So dividends have to be in some way regular. We also have stock dividends, which are payments in stocks. We treat this as income that is then immediately reinvested and recorded in the financial account. Okay. Another form of investment income is called reinvested earnings. This is an imputed financial transaction, meaning no money actually changes hands. Why do we do this? So the retained earnings of a corporation are assumed to be distributed to the owners, who then reinvest it back to the corporation. So when a corporation makes money, part of that will be distributed as dividends, which is what we talked about before this, while the rest are assumed to be distributed and then reinvested back. So this is done in order to keep track of what
respondents are earning in country in question. In terms of recording in the primary income account, this is under reinvested earnings, and the counterpart transaction in the financial account is similarly called reinvestment of earnings. Okay. Of course, your reinvested earnings will be proportional to your equity share. Here's a rough formula for how to compute reinvested earnings. So it's essentially everything that remains after paying dividends and interest and rent. All of that reinvested earnings and is assumed to be brought back into the company. Okay, the final account I'm going to talk about is the secondary income account. These allow all net or all the unilateral transfers between residents and non-residents. It excludes capital transfers, which are recorded in the capital account. So let's define what we mean by a transfer versus other types of transaction. So for a transaction to be a transfer, there has to be the provision of a good, service, or asset with no corresponding return. So if there is a return, then that's called an exchange, which is the type of transaction found everywhere else in the balance of payments. Another distinction we have to make is between a current transfer and a capital transfer. So a capital transfer refers to changes in the ownership of assets, whereas everything else will be a current transfer. So if we just give money from a resident to a non-resident, then that's a current transfer. But when you actually give assets or ownership to the asset, then that counts under capital transfer, which will not be in this secondary income account. The types of transfers that we can do are the following. The first is personal transfers. This includes the very important BOP item, the workers' remittances. These are these are earnings that workers receive and then send to fellow residents elsewhere. Personal transfers also includes transfers from lotteries and other forms of gambling. So international gambling destinations are usually attract non-residents, and whatever winnings they get will be counted under secondary, under current transfers. It does exclude allowances from parents to students studying abroad. So if a student is studying elsewhere and they receive allowances from their parents, that is considered a resident-to-resident transfer and would not be counted under personal transfers. However, those expenses, of course, will be recorded under purchases of education or travel services. It also excludes sending money abroad to your own bank account. So let's say you are an investor and you have a bank account elsewhere. If you send money to that account, you're just basically sending money to yourself, and it will not be considered a personal transfer. Instead, it will be considered a financial investment in the financial account. All right, taxes. This includes all taxes on income and wealth and so on, except number one, taxes on products in production, which is counted under primary income. It also excludes taxes on the ownership of land. So like we said, all land is theoretically owned by the territory itself. So these would not be in the BOP since they are owned by residents. It also excludes inheritance taxes because these are counted under capital transfers. Refunds of taxes are recorded as negative taxes. Social contributions. Recall that under compensation, we include the social contributions that are payable by the employer. This would be here, the employer's contributions. This is counted under compensation because later on, we will also count this under a social transfer by the employee.
So the total transfer by the employee would be derived by this equation. You have the employer's contributions plus the employee's contributions plus any other contributions that arise from pensions subtracted by a service charge. The service charge, of course, will be in the services account. There is a slight complication with pensions. So pensions, since this is an ownership of an asset, um, this is recorded as both in the acquisition and disposal of financial assets as well as a current transfer. So in a way, it's double counted. So what we need to do is to adjust the secondary income account so that we remove this component of uh, the social contributions. Okay, insurance premiums and claims. Um, Again, the services charge will be deducted from this and counted under services, purchases of services, and so that you get net insurance premiums. A similar concept would be sovereign guarantees. So if you have a debt and the government or a body guarantees that debt so as to make it cheaper, that part will be counted under insurance and it will be treated in the same way. Okay, finally, we have current international cooperation, which includes transfers between governments and international organizations. Um, this can be in the form of aid or in the form of contributions by member countries to the international organization that they belong to. It excludes technical assistance tied to capital projects because these are recorded under capital transfers. It also excludes debt concessions for the reason that they are difficult to record. So the BPM 6 says that ideally we want to include this, but because there has not been a consensus on how to record it in the SNA, the recommendation is to not include it, but to add it in as a supplementary item for extra information. All right, and in summary, the secondary income account looks like this. Notice we have personal transfers, all the other transfers, and then we have an adjustment item here for pension entitlements. Okay, and that is my presentation. So if we can move on to George so she can talk about capital and financial accounts. Uh, and then maybe we can do questions after her. All right.
All right, thanks, Ken. So as Ken mentioned, I will just be continuing what he started and presenting on the other accounts included in the BOP, which are the capital accounts, as well as the financial account. So the objectives of this particular, like the second half of the session, is to introduce the capital, financial, other changes in financial assets and liabilities accounts, as well as their relationship to the international investment position. Another objective is to establish the interdependencies among the BOP accounts that I mentioned here earlier and the IIP, and also to situate the BOP accounts and the IIP within the larger national accounting framework. So the outline of the presentation will go as this. So I'll be going through the different accounts as well as the IIP. And for each, I'll be discussing some of its aspects, such as its definition, coverage, its manner of recording, its correspondence or integration with other accounts, and I'll be presenting some sample data. So let's start with accumulation accounts. So accumulation accounts basically includes the or accounts for the or records the flows within an economy. So flows pertains to the creation, transformation, exchange, transfer, or extinction of economic value. So it includes changes in volume, composition, or value of an institutional unit's assets and liabilities. So the accumulation account in particular pertains to, or rather, covers the acquisition and disposal of assets and liabilities, their financing, and other changes that affect them. So, practically speaking, this is what the accumulation accounts cover. You can see the green bracket here. So, you have the current account, which Ken discussed earlier. So, the accumulation accounts, on the other hand, include capital accounts, financial accounts, and other changes in financial assets and liabilities. So if this had to do with goods and services and incomes, this has to do with assets in general. So the assets that feed into the production and income that happen in or are recorded or are captured in the current accounts. So I'll be discussing these in detail in the subsequent slides. And then here, I put some brackets here because later on I'll be explaining the relationship between the capital and financial accounts, as well as the relationship between the financial and the other changes in financial assets and liabilities accounts. So let's go first to the relationship between the capital and financial accounts. So the financial account measures how the net lending to or borrowing from non-residents for goods and services, income, and capital is financed. So there is a direct relationship between the two. It's necessary. I'm not sure if Ken mentioned this earlier, but within the framework, all transactions or flows are necessarily valued in monetary terms. So there has to be a corresponding financing scheme behind the acquisition and disposal of assets, capital assets. So it just means that if there is an increase in the acquisition of capital assets, which appears in the balance of payments as a debit, then necessarily the country has to increase its net borrowing or increase its holdings of financial assets to finance that kind of acquisition in capital, if that makes sense. So operationally, the current account balance plus the capital account balance is equal to the net lending or borrowing from current and capital accounts. So this net lending and borrowing from current and capital accounts, as I mentioned, is financed with assets in the financial account. So subtracting the net lending or borrowing from the financial account should lead ideally to zero. So simply put, it's just saying that the financial account, the assets in the financial account covers the net lending or borrowing from the current and capital account. So it's financed by it. However, in practice, this rarely happens. So there are some, it's either a negative or positive number, non-zero number. And that discrepancy between the two net lending and borrowing balancing items are attributed to net errors and omissions. So it sometimes means that the recording of the for example, the capital account credits are too low or too high, or the recording of the financial assets or liabilities are either too low or too high, in such a way that it no longer matches the current and capital current account goods, services, and income and capital account items monetary value. So it's like you have too much money, and it doesn't correspond to any of the economic assets. So for the accounting principles, this is generally the same as the principles with the current account. So I just thought it was worth mentioning again. So regardless of whether an item is or belongs to the capital account or the financial account, the time of recording of flows is on an accrual basis, meaning it is recorded at the time the economic value is created, transformed, exchanged, transferred, or extinguished. Um, and the kind of like the turning point, like when you record something, uh, or like when you record the transaction as already like happening between your residents and non-residents, is when there is a change of economic ownership. So that is the asset, whether capital or financial, switches hands or ownership from a non-resident to a resident, or the opposite, from a resident to a non-resident. So when that happens, the full risks, rewards, rights, and responsibilities of holding that asset accrues to the new owner. So although this is just like the ideal way to deal with it, however, in real life, it's um, virtually impossible to observe all of these changes in economic ownership, unless of course it's documented. So one of the practical ways of determining this, or rather, or kind of like one of the practical ways of like getting a signal on when to record a flow as entering your BOP, is when it enters a transaction. Is when the transaction enters in books and there is a corresponding change to assets and liabilities. Most of the time um, from the supplying party, because it sometimes happens that there are discrepancies between the time with which the new owner received and the previous owner sent or transferred the economic asset. So, given the choice by practice as a rule of thumb, we just use the time of recording of the supplier, or like from which the economic asset came from. So adjustments may be necessary. Like I mentioned, there may be discrepancies because of time zone differences, or just the time it takes to settle or clear a certain transaction. So in terms of valuation, regardless of the type of asset, financial or capital, they are valued at market prices or their current exchange value. So these are the values at which goods and other assets, services, and labors are exchanged or could be exchanged for cash. So this pertains, so realistically, the price is only is the prices, the market price is specific under certain, or under the exact exchange conditions which the transaction happened. So it's kind of unique for each transaction. This is as opposed to the general prices for, or free market price, where it's determined for a class of assets or for a period of time. So for this, actual exchange values would do after taking into account rebates, refunds, and adjustments. So we assume that actual exchange values reflect already the price for one specific exchange under certain conditions. So when prices are unavailable, we typically approximate using market prices of similar items with adjustments for circumstantial differences, or if the time between the acquisition and the disposal of a certain asset is just small, we can use the cost of acquisition. Um, However, I read that because of the difficulty of doing this for each and every type of asset, and given like a specific, within a specific date between specific parties, it sometimes like price indexes or general prices are used to approximate. Um, but of course, as much as possible, when data is available, actual exchange values are preferred. So for the entry, in principle, it follows the quadruple entry bookkeeping. So it's consistent. So the recording is like, for example, whenever a country records a transaction, for example, like acquiring a certain certain capital asset, for example. So that will the acquisition of that will be a debit in the capital account, and then it should also be reflected in the financial account where its financing is accounted for. And then the horizontal double entry, meaning like from whom the transacting the counterpart transacting party should also make the same entry in its box or in its balance of payments, recording the disposal of a certain capital asset, and an increase in its financial asset as it received payment from the purchasing party. So, as Ken mentioned, this is for national from the national perspective. It's only necessary that they have the since the transaction is between residents and non-residents. It's only necessary that the vertical uh, double entry bookkeeping practice is maintained. However, it should be at the very least cohesive with the corresponding entry in the counterpart country. So the other half of the horizontal double entry is taken care of by the counterpart country or non-resident unit. So the purpose of following the BPM6 manual and the framework definition in like consistent consistent kind of definition of concepts is so that even without regard for the horizontal double entry of the other party, there's kind of a general force making these recordings consistent between two parties. If they follow the same manual and the same framework, then it should roughly um, be the same. So there is also an exception for changes in financial assets and liabilities account. The entry is only a single entry since it's non-transactional, so there is no other party, so to speak. Like it's just a depletion or like an acquisition or disposal equivalent to an acquisition or disposal on the one party side. So there is no other party with which some economic asset is traded. So it's only single entry bookkeeping. And then we have the gross or net recording. It actually depends on the account. So for the capital account, the recording of assets and of credits and debits are on a gross basis, whereas for financial and other changes in financial assets and liabilities account, the recording of assets and liabilities are on a net basis. So when we say net, it's not netting assets minus liabilities. It's netting the acquisitions of assets and the disposals of assets. And on the other hand, netting the acquisitions of liabilities and disposals of liabilities. So they are maintained in separate columns. It's only when we reach to the IIP, the net IIP, that we subtract the net assets and the net liability. So we'll go further into that later. So the correspondence is this. So in the BOP and the IIP, the here, this one, I'll show you this. So the financial account and the other changes in volume in financial assets account actually comprise or account for the difference in the opening position of the international investment position and the closing position of the international investment position. So I'll go further into this later, but these are basically, if you remember the basic SNA, these are the stocks or positions. And so these are like the levels of financial assets that a current economy has in balance with non-residents during this typically the beginning of a year and the ending of the year. And then the difference between the two, the increase or decrease within the year, is explained by transactions or flows in financial assets with other non-residents. So in SNA, this is part of, or this is seen as the BOP, is seen as the rest of the world accounts from the perspective of resident sectors. So it's limited in a sense, like SNA is the broader framework. It's limited in a sense that it only accounts for transactions and positions between residents and non-residents. So it does not include transactions and positions between residents. So it's the international account, it's the rest of the world account sector in the SNA. So now let's move on to the first of the accumulation accounts. So this is one of three. So we have the capital account. So capital account basically records the gross acquisition and disposal of non-produced, non-financial assets between residents and non-residents. So when we say acquisition and disposal, um, it pertains to a change in economic ownership. So it consists of a reciprocal exchange of economic value between two parties in mutual agreement with each other. So it's a transaction. So an acquiring party would take ownership of an economic asset, and the disposing party would be giving or transferring economic ownership of a certain asset. So in this case, the asset is, for the capital accounts, non-produced, non-financial asset. So when we say non-produced, it results from not results from a production process. Non-financial, it does not pertain to financial instruments. We'll go into this more later. It could be tangible or intangible, and it is an asset. It is considered an asset because it can store value. It can carry value across accounting periods and serve as an input to production. So when we say between residents and non-residents, I think this was defined earlier. So residents are the residence of a certain institutional unit is determined by the economic territory with which it has the strongest connection, where it has its center of predominant economic interest. So when we say non-produced and non-financial assets, we have here three broad types. So we have natural resources, contracts, leases and licenses, and goodwill and marketing assets. So an example of a non-produced, non-financial assets are natural resources, which include land, water, and airspace and the electromagnetic spectrum, mineral, forestry, and fishing rights. Typically, these are immovable assets. So it's not often that a non-resident can actually own a like the natural resources, especially like land, water, airspace. Typically these are just they are just given kind of permissions to use these assets, these natural resources. So it's not entirely full ownership in a sense that they don't bear the entire risks and benefits of having the natural resources. So most of the time, the non-produced, non-financial assets falls under the second category. We'll go into that later. But for like the direct sense of ownership, non-resident, in like for example land, it's typically like for example an embassy or a international organization acquiring some space in a national territory. But aside from that, this is very rare in the sense of like a full ownership kind of setting. What's more common is between residents and non-residents is like non-residents entering into some contract or lease or license of a certain natural resources. So natural resource. So a contract, lease, or license is an intangible asset created by society and its legal system, granting permission to use produced or non-produced resources, undertake activities, or purchase a good or service on an exclusive basis. So one of the contracts, leases, and licenses can be applied to natural resources, as I segued here, but it can also be applied to produced resources. So this is kind of like um, an something that grants you a right to use something, do something, or buy something. So that's essentially, it is considered, though intangible, a non-produced, non-financial asset. So the ownership or the exercise of, so the ownership of the specific asset is not necessarily fully the contracting parties or the non-residents or the residents in the other perspective, but it's just the right to use and so on and so forth that's awarded to um, the party. And then we have here a third and kind of broad type of non-produced non-financial asset, which is goodwill and marketing assets. So this is also an intangible asset that can comprise of a brand name, trademark, logo, domain names, um, which enter as in the capital accounts as non-produced non-financial assets when they are sold separately from the entity that owns them. So this is to differentiate between, for example, like making a brand name or making a logo or paying for a domain name, because those things are technically services. But whenever the value of a certain brand name, logo, or domain name exceeds that of that service paid for it or to create it, then that is already considered kind of like the contribution or the product of a certain institutional unit's goodwill or marketing or like brand identity. So that also enters when it is realized, meaning when it is traded as non-produced and non-financial asset. And then we have another component of the capital account, which is gross capital transfers, receivable and payable between residents and non-residents. So when we talk about transfer as opposed to a transaction that we mentioned earlier, it is a change in economic ownership of asset, but without kind of like a reciprocal exchange of economic value between the parties. So it's just a one-way transfer of economic ownership. So there is no corresponding transfer of an economic ownership, for example, of currency. So that's typically what happens in a money-based kind of economy. Like you trade something, like you you give ownership of a certain capital asset, for example, like a contract or a license, and then you in turn are reciprocated with an ownership, or you're given ownership of a financial asset like money, currency, for example. So in this type, um, typically that reciprocal exchange is absent. And then when we talk about capital here, it's just assets other than cash or inventories. So I'll go into this later. This is kind of is something that diverges from the national accounts definition of capital. So I'll go into that later. And then residents and non-residents, again, um, is the same as the one before. So it's where predominant economic interest resides. So there are several types of capital transfers that are or should be recorded in the capital accounts of the balance of payments. So obviously, it's any um, exchange or transfer between a resident and non-resident. That's like the fundamental qualification of a transaction for it to be recorded in the BOP. So we have here just different. I'll just go through it very quickly because these are very specific details. So an example would be debt forgiveness. So for example, the non-resident. So for example, you have a liability to the non-resident, a a capital liability, for example. You were supposed to pay him a certain amount of asset, but then um, the non-resident decided to forgive the debt so that in a way the capital that you um, um, asserted ownership over and are no longer paying for was sort of is sort of credited or added now to your capital account. So you also have non-life insurance claims, investment grants. So investment grant is something probably like what ADP does. So capital transfers in cash or in kind made by governments or international organizations to other institutional units. But here the specific qualifications is that it is used to finance all or part of the costs of their acquiring fixed assets. So it's necessarily supposed to be spent on assets. So it's just not financial. It's not technically financial here. It's rather like it may be like the transfer may be monetary or in cash, but the end use of it is the procurement or the acquisition of a capital transfer. Of a capital asset. So it could also be guarantees or taxes or other capital transfers. So here you can see there's like compensation of damages or injuries, large gifts to donations, inheritance for gross fixed capital formation, and debt payment. So all of these kinds of capital transfers are recorded in the capital accounts in the balance of payments using the accounting principles that we discussed earlier. So it's recorded upon the change in economic ownership, in market value, and using a like a double entry counting method because it is after still between two parties. It's a transfer. So when we integrate all of these, both the two subtypes of current account assets, we have this here. So current account balance minus the acquisition of non-produced non-financial assets plus the disposal of non-produced non-financial assets plus capital transfer receivable and minus capital transfer payable equals the capital account balance. And then summing these two, the current account balance and the capital account balance, equals net lending or net borrowing for current and capital accounts. So this is particularly important as we go along later. We will, as introduced earlier, this has a relationship with the financial account. So this serves as like the link between these two accounts and the financial account. And then the financial account is obviously linked to the IIP. So it just basically says here that, so yeah, the negative signs denote a debit or a spending. So when you acquire non-produced non-financial assets, that's a spending on your part. But when you dispose of it, that's sort of a credit or earning on your part. Same with a capital transfer, and it's opposite for capital transfer payable. So the correspondence is this. So within the BOP and the IIP framework, the component of net lending to or borrowing from non-residents for goods and services, income and capital, so this component here, is financed by assets in the financial account. So its financing is essentially like recorded or covered by the financial account. So an increase in credit here increases kind of increases the probability that you'll be lending since you have kind of so an increase in lending and vice versa. So I'll just go into this later. So for the SNA, it's kind of a subset of the capital account in the SNA, since one again, because of the fundamental criteria that it's just between residents and non-residents, so it doesn't include any capital account transactions between residents. And there's this distinction that in the capital accounts in the SNA, produced assets, such as fixed assets, inventories, and valuables, are actually included in the capital accounts. So here in the BOP, these transactions and produced assets are migrated to the goods and services accounts of the international accounts, like what Ken discussed earlier. So it's I'm not sure for the reason why, but produced assets are not distinguished whether they are destined for capital or current purposes. So they are just lumped together um, in the current accounts. That makes sense. So, however, the balance in the capital account and net lending or net borrowing in the BOP and the national accounts are still equivalent. So this is just like what it looks like on a more detailed level. So you have here sometimes depending on government reporting requirements and whether or not they're adhering to a certain standard and whether or not data is readily available, they typically further disaggregate uh, items in the capital account according to the institutional sector that kind of had ownership over the transaction. So you see here like capital transfers. We have here from the government, general government, and the non-resident party. And then the rest of the institutional sectors, financial, non-financial corporations, households, and non-profit institutes serving households. So, but then the general structure of the data remain the same. So you have the capital account balance, acquisition and disposal of non-produced financial assets, and capital transfers, which if you add this capital account balance with the current account balance, you get net lending, net borrowing from the current and capital account. So let me just show you like what data typically looks like on this. So here I just downloaded some data from the IMF website for the BOP of Japan. So we see here the current accounts that can discuss. So this is the standard BOP presentation. So in IMF, based on their reporting requirements, there is quarterly and annual data. However, in the Japan website, they actually collect data on this on a monthly basis. So you have here quarterly data up until the very current quarter, the most recent quarter, quarter 2, 2020. So we have the current account. And then here we have the capital account. So you have disposals, acquisitions, transfers, so on. So yeah. So it aggregates in a sense that the gross disposals should equal the gross disposals of non-produced acquisitions and disposals of non-produced assets. When you net this should be the balance on, wait, let me show you this one. So I just changed the orientation. So instead of like stacking the credit and debit entries, I just put it into separate columns. So we'll see here in the capital account, the disposals and acquisitions are netted out, or sorry, are the balance between them are obtained. And then the sum of the balances between the individual components, that would be your capital account balance. And then your net lending from current and capital accounts would be the current account balance here in cell B68 plus the capital account balance. So I'll illustrate later what the relationship what relationship this has with the financial account balancing item. So returning to the presentation, we'll now go into the next accumulation account, which is the financial account. So the financial account records net transactions that involve financial assets and liabilities that take place between residents and non-residents. So as you can see, there's like a consistent way of defining. It's just that there are some aspects of it that change. Like for example, here we're also transactions. So it's like a mutually agreed upon interaction where there is an exchange of value or a transfer between two residents, a resident and a non-resident. And then each transaction consists of two economic flows, one in each direction, payment and receipt. So when we say financial assets and liabilities, these pertain to economic assets or liabilities that are financial instruments. So they include financial claims, where there is a counterpart liability. So for example, um, so a claim is sort of like when you have a check, for example. So that is a claim in a sense that it allows you to obtain a certain, or like it entitles you to a transfer of economic ownership of a certain asset. So there is another party who's liable to give you that certain economic asset. So financial claim. And then you have monetary gold, which is not a claim. Like you can't demand any other financial asset using gold, but it serves as a means of financial exchange and serves as a reserve asset for monetary authorities and financial institutions. So it has some quality. So it is considered a financial asset. And when we say net transactions, as I mentioned earlier, it's presented in a net or recorded in a net way, like the acquisitions of financial asset, the reductions in financial assets are um, subtracted from the acquisitions. So note that it's not netting between assets and liabilities, but rather between acquisitions and disposals of either assets or acquisitions and disposal of liabilities. So it's shown separately for financial assets and liabilities. So as you'll see later, there's a column for net financial assets and another column for net financial liabilities. And then again, as is characteristic of any BOP transaction or flow, it's between residents and non-residents. So there are several ways of classifying transactions or flows in the financial account. It could be by instrument, by maturity, by currency, or by type of interest rate. These classifications are actually consistent with the classifications in the standard or in the SNA framework, and also in standards for like government finance statistics or monetary and finance statistics. Um, so it's just different ways of um, classifying in classifying financial assets according to certain characteristics they have. So this one is like by instrument is by like legal characteristics describing the underlying relationship between the parties. By maturity is like liquidity dimensions of the financial instrument. Is it short term? Is it long term? By currency, like in what unit of account or denomination is it recorded? Is it domestic or foreign? Or by the type of interest rate that certain financial instrument has. Is it a variable rate in that it's linked to a reference index, or is it fixed? So for our purposes, however, in the balance of payment, the standard classification is the functional category. So it is the primary classification used for each financial transaction, position, and income. Though these functional categories are not being used in the financial accounts of in the SNA or other finance statistics, there is actually like a direct correspondence between these classifications and the functional categories. So they are linked. However, the choice of functional categories over the others for the BOP is that because it highlights some features particularly relevant for understanding cross-border financial flows and positions. So the functional categories are these five actually, but this sixth one, where data is available and where it's significant, is recorded as a memorandum item in the balance of payments. So you have first the direct investment. So it's a financial asset, holding of a financial asset wherein a resident has or can exert because it holds that certain financial asset is it has or can exercise control or a significant degree of influence on the management of an enterprises that is resident in another economy. So this is typically like if you're a resident, for example, and you have share like shareholdings in a non-resident company, then this could be taken to mean or um, um, is under this investment category. So it also includes investment in indirectly controlled or influenced enterprises, investment in fellow enterprises, debt, and reverse investment. So um, this, for example, if, for example, you own shares in a holding company, which in turn owns or exercises some degree of influence over other subsidiaries, then that non-resident can be said to have also some direct investment in the subsidiary. So, and then you also have different type of investment, portfolio investments. So it's debt or equity securities, than those included in direct investments. So I think the operational difference here is that this does not necessarily, this is more like a financial rather than um, a management thing. Like there may not be um, this ownership of these certain portfolio investment financial assets may not allow or give you certain control or influence over the management of a certain enterprise, but rather it's more of a like financial kind of asset in that its significance is more of a store of wealth or an exchange of value, um, those things like that. So it covers securities traded on organized or other financial markets. And then you have financial derivatives or options, which are instruments linked to another specific financial instrument, indicator, or commodity through which financial risks can be traded in their own right in financial markets. So this one is actually not included in the financial account per se, but it is classified as a revaluation and included in the other changes in assets and liabilities account because there is no real kind of like economic asset. Like there's no real like ownership of a certain economic asset, but rather like the value of an existing economic asset just changes based on financial derivatives and the terms of financial derivatives and options. If you get what I'm saying. So there's no real creation of a financial asset, but rather just a change in its value. And then you have other investment. So you have, this is a residual category that includes positions and transactions other than those included in the direct investment, portfolio investment, and financial derivatives and options. So it includes other equity, importantly currency and deposits, loans, insurance, trade credits and advances, other accounts receivables and payables, and SDR allocations. And then you have um, these four mostly take place between private institutions, but also, of course, like government institutions in countries, but even more so like the private sector. However, these reserves, this fifth category are transactions primarily between two monetary authorities or between a monetary authority and the financial organization for reserve purposes. So it's like an exchange of financial asset between them, um, whether it be certain claims or gold bullion. If gold bullion is traded by non-monetary authorities or between regular institutional units, then they are monetized and they are just sold not as like reserve assets, but just as they are like gold bars. So they don't have a direct implication uh, on the balance of money or on the supply and demand of money. So it does not it no longer affects that kind of portion of the economy. So it's more of a commodity or a regular asset than anything else. And then we have here when it's significant and when data is available, typically uh, governments also include this in their financial accounts. So you have arrears. So they are just amounts that are unpaid and past the due date for payment. So they enter into the financial account um, when there is, for example, a restructuring of debt or an update in the terms of a certain contract, then the amounts that are unpaid resulting from that change are added into the financial account as a memorandum item under the heading arrears. So okay, so given all of these, like these are all the financial assets recorded, like transactions in these kinds of financial assets are recorded in the financial accounts in the balance of payments. So in single view, this is what it looks like. So you have and then this schematic also shows you the relationship um, of financial account and the IIP. So the beginning period position of assets or the beginning IIP and assets and liabilities are here on top and the end are here at the bottom. And then sandwiched between them are kind of the net acquisition of financial assets and net incurrence of financial liabilities, comprised of, as I mentioned, these classes of financial assets. So net here means that the acquisitions of direct investment, portfolio investment, and so on. Um, from there, the disposals are subtracted. So net acquisition of direct investment minus disposal of direct investment equals net acquisition of direct investment. And then this is just the sum of all of these components here. And then same with liabilities. So acquisition of liabilities in the form of direct investment minus disposal equals the net incurrence of um, direct investment liabilities. And then the sum of that again is just this figure here. So we showed that the net lending and net borrowing from the financial account is related to the net lending and net borrowing from the current and capital account. So I'll go further into that later. But for now, it's worth noting that if you add the beginning period position of assets, and so this is like the stock, and then the flow, um, the net acquisition of financial assets, and later on we'll go into the detail of net changes in financial assets due to other changes, you'll end up with the end period of position of assets. So this sort of like drives the stock. These transactions drives the stock or level or position of financial assets in your balance sheet, or this case in the IIP. So same with the incurrence of liabilities. So as I mentioned, there is a correspondence between net lending and borrowing in the current capital accounts and the net lending and borrowing in the financial account. They are ideally equal, and any difference between them are recorded as net errors and commissions. So, along with other flows, the account for the difference between the opening and closing IIPs. So, that's the relationship with the IIP. And then in SNA, again, it's like a subset of the financial account in the SNA because, again, these only take into account financial transactions between residents and non-residents. And I'm pretty sure there are also some differences in the included financial um, to take into account of the different nature of like cross-border transactions. So, and then the difference is the functional categories we discussed earlier are not used, typically not used within the SNA. So it's mostly typically from what I saw, it's mostly classified sorry, by instrument. And then if you're familiar, there's also like in the external debt statistics, you can also see this by maturity kind of item for debt. So it's more of these classifications rather than the functional classifications. But again, a direct correspondence between these categories and the financial instruments exists. It's in the BPM manual. There's a table explaining the correspondence, but I'm not going to show that anymore here. So this is the standard composition of the financial account. So obviously there are more like sub items than like the schematic like I showed you earlier. Like aside from classifying it according to functional categories, there are sub classifications or sub functional categories. So you have under direct investment, you have equity and debt instruments. And then under those two, there are further classifications depending on the type of control, so on and so forth. So just to show you a sample of what that looks like, this is a standard IMF reporting report that I showed you earlier. So this is for Japan, but it uses the IMF standard template. Um, Again, this is what it looks like in the standard. So the acquisition of financial assets and the incurrence of liabilities are stacked. But for easier analysis, I just kind of transpose them into two columns here. So there's no balance here because it's not suggested that we subtract the two. It's not the way we net it. Again, the netting is between the acquisitions and the disposals rather than assets and liabilities. So ideally, the net lending from financial account is just equal to this. But Japan reported some net errors and omissions. So what I did to derive the net lending from financial account was just subtract the net lending from current and capital accounts. Subtract the net errors and omissions from the net lending from current and capital accounts to get the net lending from financial accounts. So yeah, here you have the functional categories, reserve assets. So reserve assets are notably placed under net acquisition of financial assets only. There is no liability item for this. Okay. So now we move on to the other changes in financial assets and liabilities account. So this is kind of like much more connected to the previous financial accounts because they deal in the same financial assets. However, this one particularly refers to changes in financial positions that arise for reasons other than transactions between residents and non-residents. So it's kind of like the net changes. When we say net, it's again the difference between the acquisitions and disposals in value or volume of assets and liabilities from other economic events. It's also called other flows. So it it is primarily classified into two. So you have other changes in the volume of financial assets, and then you have changes in the value of financial assets, which we put here under revaluation. So other changes in volume has something to do with these kinds of economic events. So you have cancellation and write-offs of financial assets, like when they are disposed of, for example, or discarded or reclassified, or when persons and other entities are changing their residence, so they will now leave your financial asset account. But it doesn't really have anything to do with an exchange in economic value. Rather, it's just like kind of like a correction or like a more accurate, like you moving towards a more accurate accounting of your residence, for example, financial assets or claims on non-residents, or like if you get what I mean. So it's not a transaction. That's the fundamental difference here. So you also have insurance reserves, special entitlements, and provision for standardized guarantee schemes. I won't get into this, but generally, yeah, it's just important that it's changes in the volume, not resulting from transactions. And then you have changes in the value, which doesn't have anything to do again with transactions, but rather change in the monetary value due to changes in the level and structure of its price, whether realized or unrealized. So there can be two sources or two channels for price effects to be transmitted into the financial assets value. So it's through the exchange rate. Since remember, we're dealing with um, assets between two different economies, or like between residents and non-residents. So where it exists, there are some differences in their currency. So um, there has to be like application of a exchange rate. So when this is affected, uh, when this changes, when the exchange rate changes, then the value of the asset um, in the financial account changes. However, there is no actual like economic transaction occurring, so it's just classified under revaluation. And then you have also other price changes, so changes from other causes such as asset price volatility. This is especially true for financial assets that are traded, like for example, financial derivatives or portfolio investments. So these are often traded in established markets, so there is some price volatility to it. But the changes attributed to changes in these exchange rate or prices are what are kind of netted out of the financial accounts and just put under the revaluation account within the other changes in financial liabilities accounts. So integrating the whole thing, we see here that from a while ago, we derived this net acquisition of financial assets and net incurrence of liabilities. So here we also have net changes in financial assets due to other changes, which include changes in volume or changes in value under these two sub accounts here, and then changes of in value due to these types of changes here. So when we add the net acquisition of financial assets and net changes in financial assets due to other changes, we have here kind of like the full accounting of the difference between the end of period position of assets and the beginning period of position of assets. So these two accounts combined account for the difference in the IIP statement, as I'll go into later. So along with the financial accounts, it determines the closing IIP. So you can also like from another perspective, instead of the difference, like you add the two, you will be able to calculate the position of the assets for the ending or closing IIP. Then again, within the SNA also has an other changes in volume account and the revaluation account. However, again, the difference is that this is between residents and non-residents only. So, and then it does not include other kinds of assets. So it's limited to financial assets, whereas the other changes in volume accounts in the S&A includes all kinds of assets. So produced, non-produced, financial, and non-financial. So this is sort of a subset of it. So this is just the standard composition and data again. So we have here net changes in financial assets due to other changes, which are um, classified or categorized according to the functional categories consistent with the financial accounts. So that's it we have here. So we do it for assets and liabilities, and the netting occurs again between the acquisition and disposal rather than assets and liabilities. So you have changes in net IIP arising from other changes. So the dataset I obtained for Japan doesn't actually have other changes in volume. So what I tried to do was, so I had the opening position. This is just equivalent to this is for year 17 generally. So the opening position is just the end of year position in 2016, which is assumed to be the opening position in 2017. And then you have here the sum of the transactions. So some of the financial transactions rather. So this is just equal to uh here the net acquisitions of financial assets for the assets part of the investment position. Oh, sorry, I'll just discuss the international investment position first. But anyway, I just wanted to illustrate how I was able to derive other changes in volume by subtracting from the closing position the sum of the opening position and transactions that occurred within the year, so that this is the other changes in volume. So moving on, we have here the international investment position. So if we had the flow accounts earlier, this is now kind of like where we account for the stocks or the levels or the positions of assets that we mentioned earlier, in particular financial assets. So it is a statistical statement showing the position of financial assets that are claims of residents on non-residents and gold bullion held as reserve assets and financial liabilities of residents to non-residents at a point in time. So when we say it's a statistical statement, it's kind of it's a balance sheet. So in a balance sheet format. It's a subset of the national balance sheet. We'll again mention like how it's different from the national balance sheet. And then when we say position, it has to do with the level and value of assets rather than compared to the capital and financial accounts. We were talking about flows or transactions. So this is like kind of a static thing at a point in time, whereas that one, it's a set of values that occur for a certain duration or between 2 points in time. And then we have at a point in time. So typically it's either at the beginning of the period or the end of the period for international investment position. However, we also have an integrated international investment position. When we say an integrated international position statement, this is actually when we have an opening and a closing balance, or an opening and closing international investment position. And the IIP statement reconciles those two stocks or positions using the financial account and other changes in financial assets and liabilities account. So what we've been discussing earlier is actually the integrated IIP statement. But if you want to talk about the IIP, just the IIP, it's just when you ask like what was Japan's IIP in 2017, it's just a single figure for each category of financial asset. But if you're talking about the integrated IIP statement, then it's the opening and closing values as well as the difference between the two. So the coverage, since it's just kind of accounts for or records the difference between or the changes in the financial assets and other changes, the coverage corresponds to the financial assets and liabilities covered in the financial accounts is consistently classified by functional classification, and in some instances for some countries by instrument as well. And then further to integrate it kind of or to harmonize it with the classifications in the national balance sheet, which it is a subset of. They also include a classification by institutional sector. So this is it. Like this is what we've been talking about earlier in the other accounts. So this is what we're talking about now: the beginning of period IIP assets, and beginning of period IIP liabilities, and end of period IIP assets and end of IIP liabilities. And in the earlier accounts that we talked about, in particular, the two related to financial assets are the ones that explain the difference between the two. And then we can get the net IIP, which is just the difference between the end of period assets and the end of period liability. So it's kind of like financial wealth in a sense, stock of financial wealth in a certain point in time. So correspondence with the national balance sheet is that um, so the national balance sheet incorporates non-financial assets as well, but this is again a subset which only includes financial assets and transaction or like positions between residents and non-residents. And then net IIP, so the financial net worth, as I mentioned earlier, plus like the worth of the non-financial assets is equal to the total net worth of the economy, which is the balancing item of the national balance sheet. So because of the harmonization of statistical guidelines like BPM6 with SNA 2008 and then GFS and so on and so forth, transactions and positions with residents and non-residents are actually coherent. So you can compare, for example, international financing with domestic lending and borrowing. So you can say that based on the BOP account and the general like domestic national accounts, you can say that, for example, foreign or international borrowing is actually greater than borrowing within the economy, and that may have some macroeconomic implications, of course, like for example, in macroeconomic policy, like what if exchange rate increases, then obviously the value of the international borrowing or foreign borrowing will increase in terms of domestic currency. So that may have implications on the macroeconomic health of an economy. So these are things that obviously like play into the overall consideration of a country's economy and the policies that are put forth to kind of make it healthier or strengthen it and so forth. So the standard composition is actually just like a small portion of it. So as you can see, it's classified according to the functional category of financial assets and then some subcategories. Let me just show you. Yeah, so here, this is what the Japan data looks like. So as I mentioned, the closing position minus the opening position is just the sum of transactions and other changes in volume here. So it's recorded for both assets and liabilities, but there is also a net value at the very end, which represents the net worth in terms of like the financial net worth. And if you add that with the non-financial net worth, then you have the entire net worth of an economy. So some final notes. So these are the BOP relationships that we kept on circling around throughout the discussion. So I won't repeat it another time. I think it's pretty established by now. And then for the example, I just showed you like the Bank of Japan's balance of payments. They also have an accompanying report if anyone's like more interested in how like analysis on balance of payments are done. So you can see here sort of like notes on the methodology. It says here that they are compiled mainly from reports prepared by government offices, financial institutions, corporations, and individuals based on Foreign Exchange and Foreign Trade Act. And then the number of such reports used for BOP statistics amounts to over 400,000 a year. So meaning like it's a big undertaking to actually compile statistics on balance of payments, as again, there are so many parties involved and parties residing in different economies for that matter. So recording is much more complicated. And then as you saw, it involves various kinds of assets. That is aside from the goods and income items that Ken discussed earlier, but there's also like within the capital and financial accounts, a very diverse range of assets. And then I just want to show you like a schematic that they did here. So again, they related the whole thing. So they have the opening IIP, the ending IIP, and then current account and capital account feeding into the financial account as this has to finance these. And They also put the exchange rate here. So and then the difference in this or the changes in these obviously affects the or explains the um ending IIP. So you have BOP flows here according to the different accounts and the corresponding IIP. So the sources for data for each of the accounts are like vary. Like for example, you have here Ministry of Finance, Trade Statistics, and then other here like you have the Japan Tourism Agency, so on. So just a final note, like data sources are actually varied and there are a lot of requirements for the compilation of balance of statistics to compile balance of payment statistics. So these are just some of the sources for each of the accounts. So for the current account, you use trade, official statistics and administrative sources, enterprise and special surveys. For the capital account, surveys also statistics and other administrative sources. In the financial account, you have bank reporting, official statistics, and some international organization initiatives. And then for others, they use counterpart data, like especially for economies with low statistical capacities. They tend to use bilateral data compiled on them from their counterpart economy and just reverse the values so that it is now from their perspective. So yeah, so summary, these are the data sources. And then if you're interested in looking further into the BOP data, this is actually like where you can find like most of the countries BOP data. It's like a IMF database. And then other international organizations website like OECD and Eurostat. So as a summary, like the BOP deals with transactions and positions between residents and non-residents. So you have here your capital and financial account. Sorry, you have here your capital account um, and financial account that kind of feed into or help, in particular for the financial account, determine the opening and closing balance sheet of your international investment position, or equivalently like the net of it, like the net worth in financial terms. So this is just a subset, as you can see here, of the national balance sheet. National balance sheet, which includes non-financial assets as well. And then obviously these assets, capital and financial, all feed into or provide capital services and inputs into the current account in the production of goods and services and in the generation of income account. So this is kind of just like the overview of the general contribution of these BOP accounts in the overall national accounting framework. So with that, I end my discussion. I hope I was able to give you some insights into how the BOP is collected and what role it serves within the overall national accounting framework. If you have any questions, the floor is open.